But joining me now is Ed Yardeni of Yardeni Research. Ed, it's great to have you on. I think about you. I think about somebody who's been very bullish on the markets for a while now. But earlier this week, you did put a note out to investors basically saying, hey, there's going to be turbulence along the way here. And you did point to geopolitical tensions that could put pressure on oil prices. You pointed to the possibility of some big earnings missed and a still robust labor market that could keep the Fed from cutting rates as much as the market has been hoping. I mean, it feels like it's almost playing out in real time here on the eve of the jobs report. And as we're talking about geopolitics and the impact that had as crude oil prices moved higher into the close here, your thoughts?
Everything else, bull-bear ratios are historically quite high. Everybody's bullish, which means that we don't have too many bears or enough bears to convert to bulls. And meanwhile, the market's discounted a lot of really, really good news. I mean, my outlook was for 5,400 on the S&P 500 by the end of the year, not by the end of the week. And so I'm not really that troubled by this pullback here. I don't think it's going to turn out to be a correction. But it could be a serious problem if, in fact, we find that push comes to shove in the Middle East. Israel bombed the Iranian embassy in Syria, and now everybody's kind of very nervous that Iran's going to retaliate in a similar fashion. That could start continuing conflagration in the Middle East that could affect the price of oil. And once you know it, the price of oil, the Brent crude jumped above $90 a barrel today. And I think that's one of the things that spooked the market. The others, I think we're going to have a strong employment number tomorrow, and that will continue to take away the notion that the Fed's going to clearly cut interest rates this year. They may not.
So in light of that, is geopolitics your number one risk to your investment thesis and this bull market move that we've seen this year?
I would say it is. Historically, over the years, I've learned that geopolitical crises offer opportunities to buy. You get the sell-offs, and then the crises kind of abate for one reason or another. This crisis in the Middle East isn't going away. It's getting worse. And the price of oil for a while there, when Hamas attacked Israel on October 7th of last year, the price of oil actually went down because global demand was quite weak. But it's really since the end of last year, I think we're starting to build a geopolitical risk premium into the price of oil. And here we are at $90 a barrel. I mean, it's possible that the global economy is also doing somewhat better, but the geopolitics is my number one concern. I will not be concerned if the Fed doesn't lower interest rates, because that'll be consistent with my view that the economy is resilient.
So we saw every sector in the S&P finish today lower, but energy basically just below the flat line. We know it's the best performer this week. It's one of the best performers since the start of the year, to your point. Does that mean you go long energy equities, or how do you position yourself in this market?
Well, during this bull market, I've been recommending technology, industrials, financials, communications services, and energy. And the energy didn't do too well initially in the bull market, but I view energy as a shock absorber in a portfolio, just in case things really get much messier in the Middle East and the price of oil goes up. I mean, just looking at the charts, now that we've crossed 90, the markets are going to start thinking about $100 a barrel. And then we're looking at gasoline prices higher, and that starts to create some anxiety that it could once again cause a wage price spiral. That's not my base case, but it's not an unrealistic scenario.